Thank you for watching this video. Today we will be doing technical analysis on the S&P 500 for the week ending Friday, April 1st, 2022. And for this analysis, we will be using stockcharts.com. That is the charting service that I use and pay for, and I will leave a link to their site in the description box below this video. My name is Rodney Constable. I have over 30 years of investing experience, including over 25 years of experience trading stocks and options. I am a former financial advisor, a former vice president of a major mutual fund company, and I am the developer and president of Simple Market Signals at simplemarketsignals.com. The chart that we're going to be working off of today is an hourly candlestick chart of the S&P 500 that starts back on December 20th and runs, of course, through Friday, April 1st. And I went with the hourly candlestick because I wanted you to see virtually every hour of trading that has happened for calendar year 2022 so far. So I call this putting the market under the microscope. And let's take a look here at what has happened. But I think before we do that, let's move over here to the 1 week returns. And what we can see here is the S&P 500, guys, was up a whopping 6 basis points for this last week, right? 0.06. And if you're not completely familiar with what a basis point is, on my YouTube channel, I have a video called What is a Basis Point? Basis Points Explained. And I would encourage you to watch that and familiarize yourself with that. And we'll come back to those returns here in just a couple of minutes. But I thought we would do some analysis together. So this is a naked chart. There's nothing on this thing, and let's start marking this thing up and see what we have here. So the first thing I'm going to do is I'm going to bring up this annotation tool, and one thing I know is that this 4550 level, let me line this up here, this area is really acting as an overhead resistance point. So I'm going to save that line. So this is a 45.50 line, and you can see here, by the way, that we closed at 45.86 on Friday the 1st, and you can see that we've had very little trading, right? Just a little trading right here this past week above this 45.50 level, but you can see we kind of bumped up against it here and then settled underneath it here, and then we have to go clear back to the middle, kind of the earlier part of February, early to the middle part of February, to have any trading above 45.50 there and right there. All right, so the majority of the trading on the S&P 500, guys, and stay with me because this is super important for you to understand. The majority of the trading on the S&P 500 really since this third week in January has been below this 45.50 level. All right. And so now what we're going to do here, so that's overhead resistance, guys. And on a weekly basis, we're not going to get into that on this particular video this week, right? Because I want you to really see what's going on on the hourly candles. But, you know, we're not closing on a weekly basis, especially. We're not closing above that 45.50 level. Now let's take the annotation tool and let's pull up a Fibonacci retracement. Now, back here on the 4th of January, we hit our all-time intraday high on the S&P 500. And so I'm going to start there. And right here on the, so we're starting from the all-time intraday high on the S&P 500, and we're going to the recent lows right here on February 24th, which was right around 41.14. All right, I just have this stuff memorized, and we were at 48.18 and change right here. All right, now if you're not familiar, or even if you are, I'm just going to review the basics here of Fibonacci retracements because they're very educational. All right. So what we know about Fibonacci retracements is the standard retracement, and what we're looking at is the entire move from the peak in the markets until the lows so far of this downturn, all right? And then we're looking at how much of this movement, all right, was retraced by going back up. And a standard retracement is about 61.8% of the prior move. The prior move, again, was the peak in the market on the 4th to the lows on February 24th. And then look at this, right? And by the way, remember that 45.50 line that we put in here? Look at where this 61.8% retracement line is lining up at 45.49.70, if you can see that. Hopefully you're watching this on a computer. And where did we close this last week? 45, 45, 86. All right, guys, I didn't premeditate this. This is where this stuff is lining up. So we're up against, looking at this on various levels, guys, we're up against some critical levels at 45.50 on the S&P 500. All right. Now, if we can get back above it over the next couple weeks and continue to climb higher, fantastic. What I can also tell you, and again, I'm not going to show you this chart, is in the entire history, right? Just bear with me here. In the entire history of the S&P 500, there's only been 11 weeks where we've closed above 45.50 on the S&P 500. 11 weeks. That's it in the entire history of the S&P 500. All right. So, I know a lot of people are all excited. Boy, they want to catch this little move here, right? And they're maybe upset because they didn't get it. But guys, let me show you something. All right. Let's move over to the sectors of the S&P 500 and look at year-to-date numbers, because I want you to understand what's really going on underneath the surface. So I've set this up year-to-date, and here's the 11 sectors of the S&P 500. These are the ticker symbols that I use to track the underlying sectors, and we can see that so far, year-to-date, the energy sector is up 40.18%, guys. 40.18%. Utilities, by the way, look at this. It's the only other positive sector inside of the S&P 500, up 6.18%. Now, let me ask you, is a market really healthy when energy and utilities are the only two positive sectors year to date, right? With now a quarter and a day of trading, right? So we've got an entire quarter, the first quarter of this year behind us, and we've got two sectors positive, energy and utilities. Guys, I've been doing this for a long, long time, decades and decades. I've been doing this for longer than some of you guys have even been alive. And I'm telling you, when you see this type of a setup, that is not a healthy market, all right? And then look at this. The three most important, right? And by the way, if you were a Simple Market Signal subscriber, you would know a lot of this, because I do this type of training for my people, all right? But I'm just going to give you a glimpse at what you're missing by not working with me, by not being a subscriber, by not getting the education I provide. These three sectors right here are the three most important sectors: technology, consumer discretionary, and communication services. Three most important sectors of the S&P 500, and they're the worst three from a performance standpoint year to date, all right? So we've got 9 sectors that are negative, 2 that are positive. The 2 that are positive are not generally associated with growth, okay? And yet people are mad at themselves because they're not, maybe they didn't catch this little move here. Guys, I wouldn't be overly excited about that. Now, maybe the market did bottom back here on the 24th. Maybe that 41.14 area is the low for right now. But I think there's still potentially some risk here. Now, let's move on and let me show you something. All right, stay with this, guys. And let me also point out, right, the older you are, so if you're in your 40s, 50s, 60s, or even 70s, this data is even more important to you than if you're younger. But if you're younger, guys, what I'm sharing with you and what I'm doing here is giving you massive education that can help you make and keep your money. All right, but a lot of my, probably most of the people that work with me, my clients, are at least 40 plus years old, and a lot of them are extremely well off, millionaires or multi-millionaires, all right? And they like what I do because it's education and it helps you make and save money. And especially if you're already wealthy, it'll help you hold on to and grow your wealth in the stock market. Okay, but let's take a look here. So year to date, the S&P 500 is down 4.62%. And by the way, I've got a lot of different investments here, all right? And this is some of the stuff I track and share with my subscribers at Simple Market Signals. So I just had this up. But, look at this. Value, SPYV is up 28 basis points year to date. And the dollar, by the way, any of those, any people, the dollar's just at an all-time low. No, it's not. The dollar's actually up year to date, all right? Don't do a lot of work with that, but with the dollar, but I just wanted to point that out so you see that there's a little green there. Well, it's the dollar in value, right? It's the only thing that's working. Stuff like small caps down, FXI is down, EEM's down, all right? But the point is that we've got, within the S&P 500, we've got energy and utilities are the only things that are up year to date, and then you've got pretty much everything else is down. And also, guys, let me move over to bonds, right? Because a lot of people, they think they can't hold on to cash or whatever, or they've got to be invested in bonds because you don't lose money in bonds, right? Bonds are always a good bet. Well, look at this. This is just year to date, guys. And these are three of the most popular high-quality Treasury ETFs in existence. We've got the 3 to 7 year Treasury ETF, IEI, that year to date is down 5.51%. You've got the IEF, which is the 7 to 10 year, probably the most popular, right? Because generally, if you have like a 60-40 portfolio, you're going to have 60% in equities, something like the S&P 500, and then you're going to have 40% in bonds, something like this 7 to 10 year Treasury. You're down 6.98% on that 10 year Treasury. And then the TLT, which is the longer duration, 20-plus year Treasury ETF, you're down 10.29%, guys. This is just year to date. This is just year to date, okay? So, it doesn't even matter at this point what the yield on these things is. You're losing money, right? Net, you're losing money. And look at this. The S&P 500 is down 4.62% year to date, and the 7 to 10 year Treasury ETF is down 6.98%. Any of you that understand asset allocation, whether you're a financial advisor, hedge fund manager, a more mature and successful business owner, executive with a 401k plan or whatever, you're going to understand what I'm trying to tell you here is, guys, the game has changed. The rules have changed. The investment thesis, the parameters have changed, all right? And like Einstein said, right, we can't fix a problem with the same using the same approach. I'm paraphrasing here what Einstein said, but we can't fix a problem, with the same approach that we use to create the problem, all right? In other words, we're going to have to, if we're going to be successful investors going forward, and this is why I'm so passionate about what I do, and I really want to encourage you to watch the rest of this video because it could be worth a lot, and I'm talking, guys, a lot of money to you going forward, all right? And the more money you have, the more money, the rest of this video is going to create and help you hold on to, and that'll make more sense after you spend a few more minutes watching the balance of this video, okay? But bonds are down, equities are down, and the only thing year to date that's working in the S&P 500 is energy and utilities. And let me back this up because I want you to understand it's not just year to date, but if we go back 1 year, look at this. The energy sector is up 60%. You've got real estate up 26%, utilities up 21%. Guys, there's just, stuff just hasn't worked. And especially, over the shorter periods of time, you can see that the energy sector and utilities, even on a 6-month basis, are the best performing sectors of the S&P 500. That's not necessarily a good thing, all right? So don't worry about trying to catch a falling knife here and worry about this reflexive bounce up to the 61.8% retracement level and back to the 45.50 overhead resistance point. Maybe we'll keep going forward. But guys, we've got some challenges out here with high quality bonds, as we can see, selling off. All right. And let's take a look at some different time frames. Let's go back 6 months. Look at this. The 3 to 7 year down 661. The 7 to 10 year down 7.25. The 20-year TLT down 8.20. That's just over the last 6 months, guys. These are high-quality bonds. These are the things that you used to for the last 40 years, since 1981, right, in the peak of interest rates. You used to be able to use high-quality bonds to offset equity risk. It's not working anymore, and it's probably not going to work for a while. It's probably not going to work for years. When we have a rising interest rate environment, this is what this means to bonds. You will lose money on both sides of the equation. If you have a 60, 40, 70, 30 portfolio, guys, you're going to be losing money on the equity, especially on the bond side on the rising interest rate environment. And again, if you're using bonds to try to offset equity risk or keep up with inflation, you've got a problem here, okay? So the game has changed, and with that said, please pay close attention to the balance of this video. Now let's go back and take a look at how simple market signals could have helped you in the bear market that started in 2000, that ended in 03, and then next we'll take a look at the bear market that started in 2007, that ended in 09. So in 2000, you can see that the risk signal, the market mode signal, would have turned red right here at approximately 1450 on the S&P 500. In this risk signal, the market mode signal would have been red through the majority of this downturn. and then turned green right here just under 900 on the S&P 500. So think about that. Any of you that lived through this, any of you that were invested in the stock market during this period of time, as I was, right? I was working for Oppenheimer Funds, the mutual fund company, during this time. But you can see here, guys, this huge drawdown, right? This hurts, and it lasted for several years, and it just felt like every time we were starting to pull out of this, something would happen that would send us lower, all right? And these types of downturns, these prolonged downturns that last years, they are brutal. But think about how much knowledge you'll have when the risk signal is red whenever we get to the next bear market, right? Whether it lasts a few months or a few years, when you know that that risk signal is red, you know what to expect, right? Losses are much more likely than gains, and so you can take the proper measures to protect yourself, and you'll have realistic expectations as to what is probably going to happen. But then when that risk signal turns green, you know that the likelihood of you making money has substantially increased, okay? Now let's take a look at the bear market from '07 that ended in '09, and you can see here that the risk signal would have turned red right here, right around 1,500 on the S&P 500. And you can see that the risk signal would have been red for the majority of the downturn. We did have one short green signal right here that lasted 1 week, and then the market rolled back over. And so maybe you would have had a small loss here, okay? But that's just the way any type of protective system works, guys. But think about this. Again, you could have got out, or went to cash or done whatever you wanted to do right around 1,500 to protect your portfolio, and you would have had a green signal that would have came out around 875 on the S&P 500 right here in 2009. So 2 of these types of downturns in the course of a decade, and simple market signals could have helped you really protect yourself and really understand what was going on in the market and set realistic expectations for you in both cases. And when the risk signal turns green, as it did right here, you will know that the likelihood of you making money in equities has substantially increased. Why is simple market signals so important? Because market risk is the single biggest risk most investors face. And market risk is non-diversifiable risk. Market risk cannot be diversified away. And future investing success will require getting in sync and staying in sync with the stock market by using stock market-driven data. Simple Market Signals is built around a multi-factor stock market-based model. I'm going to repeat that. Simple Market Signals is built around, based on, a multi-factor stock market-based model. Simple Market Signals identifies the current level of market risk, giving you the opportunity to stay in sync with the stock market. Now let me share with you what subscribers are saying about Simple Market Signals. First, we are going to hear from KT from Michigan. I have been trading for many years. I did not realize that I have been trading in a completely blind fashion. SMS has given me the direction, literally, I've been desperately needing. This service allows you to clearly see what the market is doing. If you are remotely serious about trading or investing, you must try this service. Again, that's from KT from Michigan. KT, thank you. I appreciate that feedback. Next, we're going to hear from SC from Florida. And SC writes, I manage my own money and I am not a professional, which could lead to a disastrous outcome as it has for many. Simple Market Signals is the equivalent of having a personal money manager that keeps you invested when it counts and alerts you to the potential dangers ahead. Now, I want to point out here, guys, I used to be a money manager. I sold my practice in 2016. So these are the exact words that SC from Florida wrote to me. So I just printed it as is. But I want you to understand, I cannot give advice, but this is the feedback that SC from Florida gave me. So I appreciate this. So again, SC writes that Simple Market Signals helps you stay invested when it counts and alerts you to the potential dangers ahead. The service is extremely affordable and takes the uncertainty and fear out of being in control of your own investments. I have done very well using this system and consider myself lucky that Rodney's YouTube channel came into view one day. I highly recommend this to anyone who desires an easy system to produce positive returns in the markets. Again, that's from SC from Florida, sent from his iPad. And guys, I want to point out the reason I'm using just the first and last initials is for the security of my subscribers, okay? I have hedge fund managers, very well off, multi-millionaire clients. I have, people that are high up in various areas of the government. I have people from all walks of life. So just out of respect and security for my clients, this is the way that I'm presenting the information, just with their first and last initials as well as their state. Next, we're going to hear from FS from Massachusetts. Rodney is spot on in his reading of the markets. I was looking for a heads up to help me choose which side to use for vertical spreads. Again, that's from FS from Mass, and thank you so much, FS. I appreciate that. Next, we're going to hear from JV from New York. Now, I posed a few questions to my subscribers a few weeks ago, and this is the feedback exactly that JV from New York gave me with respect to the question. So I produced it just as he wrote it. So the first question, what do you like best about simple market signals? What JV said was, one of the things I like best about simple market signals is that I have an easy-to-use tool at my disposal. I use the green, yellow, and red signals along with the general trend to help me determine how much equity risk exposure I want my investments to have in the market at any one time. I will either increase or decrease my equity exposure based on those metrics. The next question, what is important about simple market signals to you? JV writes, I am a conservative investor. My main goal is to preserve as much capital as possible during market downturns, yellow and red signals, and to optimize my returns during green light conditions. The next question, how has simple market signals helped you? JV writes, SMS helps me to determine whether to stay the course, increase equity exposure, or take defensive positions. For example, I will add additional funds to my equity investments during green conditions and move money to cash during red conditions. And the last question, how have you benefited from simple market signals? JV writes, one of the benefits of SMS is that it has reduced the stress from always looking at and analyzing market conditions and worrying about it on a daily basis. And again, this is from JV from New York. JV, thank you so much for the feedback. I really appreciate that. There's two major components to the simple market signals proprietary model. There's the risk mode, the market risk level signal, and then there's the general trend indicator. Let's start off with the simple market signals risk signals. The simple market signals risk signals, the market mode signals, are simply green, yellow, or red. When the signal is green, this is when you're going to have your easiest, lowest risk profits, and this is when the market is generally in an upward market mode. When the signal is yellow, this is when we have a soft market, and the market is generally sideways to slightly up or down in a yellow signal environment. And what you're going to find is when the market mode or risk signal, right, you can refer to it either way, but when the market mode signal is red, the worst losses, including bear markets, are going to happen in a red signal environment. So when the signal is red, the market is generally in a downward mode. Next, let's take a look at the general trend indicator. The general trend indicator measures the trend of the stock market based on our proprietary formula. The signal is either positive or negative. When it's positive, we're in a upward general stock market trend. When the signal is negative, we're in a downward general stock market trend. Now let's take a quick look at a few market mode risk signal charts for the last few years. We're going to start off with 2018, and you can see here what I was talking about, that most of your upward progress in the stock market will be made in a green risk signal environment. The yellow signal is kind of a sideways to slightly up or down signal, as you see here. And then the red signal, right, this is just 2018. We'll look at a few more here in a second, but you can see the red signal here that we had in the latter part of 2018. And then moving on into 2019, we came into the year with a red signal, and then it went green, and you can see the progress that we make here. Yellow, correction, green, yellow, green, yellow, green. So you can see that most of the yellow signals go back into a green. The yellow is kind of a short pullback in a lot of cases, but as we saw here in 2018 and what you'll see also in 2020 is the yellow signal can be that transition signal between a green signal and then a red signal, as we see here with the COVID sell-off in February, March of 2020. And again, as we see here, right, most of the upward progress in the stock market is going to be made in a green signal environment. So think about this, guys. As long as the signal is green, you can see there's just not a lot to worry about, right? And even most of these yellow signals, this is when we get that pullback, but it gives you confidence in knowing what the market is doing. Now let's take a look at a few charts for the general trend indicator. And just like with the risk signal, we're going to start off with 2018. You can see we came into the year with a positive signal, had kind of a chop here where we went back and forth between positive and negative for a little while in February and March. We had an outright negative signal and then went back into a positive. But you can see here, right, this sell-off that we had in Q4 of 2018, we've already looked at the fact that that risk signal went red, and you can see here that we would have had a negative general trend indicator signal as well. And then you can see here when the signal is positive, this is when you get the most upward progress in the stock market. And this takes us into 2020. Of course, we had the negative signal right here during the COVID sell-off in February, March of 2020. And this takes us again to the end of August, beginning of September of 2021. And you can see here positive, very short negative signal, and then a nice long positive signal. And again, just like with the risk signal, I'm stopping the data at the end of August. And if you want the most current information, please become a subscriber. The signals are delivered to subscribers in our weekly video newsletter. In the weekly video newsletter, you will get weekly updates on our proprietary market mode signal. That's our risk level signal. And of course, you'll also get the updated chart for that signal each week. You will also receive the proprietary market mode risk level signal on all 11 major sectors of the S&P 500. You will also receive a weekly update on our proprietary general trend indicator signal, and of course, the updated chart for that. You will also receive market analysis on over a dozen charts every week covering all major areas of the stock market, including several international charts. So I'm going to cover small, mid, large. We're going to cover both a growth and a value ETF. I mean, guys, this is going to help you understand what's going on across the board. Of course, several charts every week on the S&P 500. We'll cover the Dow. We'll cover the triple Qs. So we're going to cover pretty much everything in there, okay? And so this is going to give you a really solid base every week as to what's going on in the stock market over and above our proprietary information that we're sharing with you. And then depending on what's going on, there will be occasional bonus material, not necessarily every week, but occasional bonus material, and this will be anything additional. From week to week, these things will vary, but these will be important and timely things that I feel that you guys need to know at the time that the information is delivered. Okay, so that'll be the occasional bonus material. To be fair to myself, I should be charging $97 per month or more for this information. However, you're going to get everything for just $19.99 per month. That's less than 67 cents per day. And to become a member of the channel and get access to the Simple Market Signals information, you will need to go to the Rodney E. Constable Stock Market channel. So depending on how you found the video, you may or may not be there, but you need to make sure that you go to the Rodney E. Constable Stock Market channel, and then you're going to click on this join button. Now, if you're not signed into YouTube, you will need to sign into YouTube. All right, and then once you're signed in, then you'll see this box pop up, right? Get access to exclusive perks when you become a member. So you click on the join button and you will see the information here, what you're going to get with your subscription, of course, your membership. And then you click on the join button and you want to add your credit card information. So as you can see here, you can pay with either a credit or debit card, enter your card number, of course, the month and year of expiration, security code, cardholder name, and your billing zip code. So I'm going to fill all of this information in, and I will be right back. So once you hit that buy button, which is in the lower right-hand corner of that box, that previous box, you will then get this pop-up. Welcome. It's great to have you as a member. So then you can click on the See Perks. So once you fill all that out and your membership is established, then you will have access to the membership area where you will be able to see the perks, right? And then you go over to the community tab, and this is where you will have access to the various videos, and you just click on those and it'll pull those up. Okay, so I'm going to back up here, and so this is where all the training videos will be, as well as the weekly updates to the simple market signals that will be under the community tab. And that's all it takes to become a member. It's quite simple. And you will have easy, convenient access to this information. Everything is on YouTube in the members area of the channel, and everything is in video format. There's no emails to mess with and no websites to log into other than, of course, YouTube. So just to review the membership details, the video membership to Simple Market Signals through YouTube is $19.99 per month. That's less than 67 cents per day, and it's billed monthly on your credit card, or you can pay with PayPal. There are no contracts. You can cancel anytime, and if you do cancel, your membership will remain active for the balance of that current month, right, for that prepaid period, but you won't be billed for the next month. All memberships are controlled by YouTube, so if you ever have any question about anything, just Google it, and the answers should be out there. Some of my clients tell me they make tens of thousands of dollars per year from the information they learned from being a client of Simple Market Signals. It's not often you have the opportunity to invest a few $100s per year in yourself and potentially pull out thousands or tens of thousands of dollars per year from that tiny investment. This year, give yourself the gift of financial knowledge that can bring you big rewards over your lifetime. Now let's recap what you will get as a member. As a member, you will receive the weekly video newsletter, which includes the weekly update on the proprietary market mode, also known as risk signal, on the overall U.S. stock market. You will also receive the weekly update on the proprietary market mode or risk signals on all 11 major sectors of the S&P 500. You will also receive the weekly update on the proprietary positive-negative signal for the general trend indicator. You will also receive weekly market analysis on the overall market, and there's generally 12 plus and sometimes more than 20, right, depending on what the information I need to disseminate, but there's generally at least 12 plus charts every weekend covering all major areas, right? Small, medium, large, growth value, all of that, including several international charts. But all of this is over and above the proprietary risk signals. So the weekly market analysis alone, guys, is worth far more than the $19.99 a month that we're talking about here, okay? Plus, you will receive occasional bonus charts as deemed necessary and appropriate for whatever's going on in the markets, all right? So that's bonus material that I do throw in from time to time, and that can be extremely valuable to you. Plus, you will receive special midweek updates when warranted. So again, if there's something going on in the markets, if there's a signal change in the middle of the week, we will put out a midweek update video so that you can stay current on the information. We'll get that out as fast as necessary, okay? And you'll also receive access to the growing video library of best practice educational videos that are part of your membership, and that will continue to grow over time, all right? Again, you're going to get all of this for just $19.99 per month. That's less than 67 cents per day. So join now to start benefiting immediately from this valuable and potentially life-changing information.